What's going on, guys? Jumping back on here for our monthly market update. October's gone, headed into November already. Hope you guys had a nice Halloween. Pretty low key on this side. Hung out with some buddies and had a nice dinner and everything, but no big trick-or-treating plans or anything like that. So, but we did get to go to Reno. Had a really big roping event here a couple weekends ago that I got to see a lot of clients out at. So, had a great time out there. And then already thinking about Thanksgiving. We're headed down to Tucson to visit some family for Thanksgiving coming up here at the end of November, and all of a sudden Christmas time. So years just keeps flying on by. But want to keep you guys updated with what's going on market related wise, what we're doing in the models, and all that fun stuff. So as I'm sure you've noticed, if you've been paying attention to the market, it's been pretty terrible here the last 3 months. So kind of looking at the numbers here of the major indexes, NASDAQ down about 5% over the last 3 months, which, you know, NASDAQ's been rallying huge this year. Tech has been a fantastic place. So NASDAQ down 5%, the Dow Jones down about 5%, as well as the S&P down almost 6%. You know, we had all the fears with the wars that are going on overseas. We have the Fed fighting inflation. A lot of the same narratives. I mean, nothing really crazy new. I'm sure you've been tired of hearing about the inflation issues and the Fed raising rates. And it's just, you know, it's been an issue for a long time, but it's just one of the main topics of conversation, and it's what's driving a lot of things right now. So, but I want to talk a little bit about what we're doing in our bond portfolio and some of the bank stocks that, you know, we've been sitting in for the last basically 5 months or so. So right now, if you did not see latest news, Federal Reserve came out and they actually said that they're going to be pausing rates moving forward. I want to show you guys this article here, actually. So officials voted unanimously on Wednesday to leave rates unchanged at a 22-year high. The committee is proceeding carefully, Powell said during a press conference where he said nothing to shift the market's expectation that officials won't raise rates in December. So obviously stocks climbed huge here. Another thing I want to show you real quick is officials have been trying to balance two risks. They don't want to overdo rate rises to avoid causing an unnecessarily severe downturn. They also don't want to allow inflation to reaccelerate or settle at levels well above their 2% target. Those risks are closer to being in balance, Powell said. So yeah, we're not at that 2% annual inflation. Somewhere 3.5, 3.7, I think was the number that I saw last. But like we've been talking about, that's some of the news that we've been waiting on. We've been waiting to hear that the Fed's going to stop raising rates. We know that that's going to be a huge, huge catalyst when they still haven't said that. They still haven't come out and just said, hey, we're done and we're actually going to start cutting rates a little bit. I think that that's still a little ways away. But even just the little smallest glimpse that they're stopping this rate hiking cycle and they're taking their foot off the brakes of the economy a little bit has just been a huge catalyst over the last 5 days. So just, I mean, looking last 5 days here, major indexes again, Dow is up 3%, S&P's up 4%, and of course, NASDAQ leading everything's up almost 6%. So really, really big rally market-wide. Today, it's actually a huge rally. I mean, everything is up. All major indexes, I mean, almost every sector that I've been looking at is killing it today. And it's just based off that same thing. Again, we're not sure that they're going to be done, but the odds are getting better in our favor that we're getting out of this rate hike cycle. So some changes that we've been looking at in the portfolios. The banks have been rebounding extraordinarily well over the last week and a half or so. KeyCorp, which we're holding, is up 8% just today. Huntington Bank up almost 6.5% today. So they're killing it. Again, we did get a little bit of downside exposure to these, probably got in a little bit too early. Timing the plays is almost impossible, right? From a valuation perspective, we're still extremely, extremely bullish on these plays. And that's why we were willing to accept a little bit of downside risk with the upside potential that we saw. Now, you know, with talks of recession and some of those fears that have been coming out in the news, we've been really, really keeping a close eye on the banks. So as of now, our game plan is to hold these up until December 15th. Reason we're waiting until then is KeyCorp actually kicks off an 8% dividend on December 15th. Huntington Bank kicks off a 6.5% dividend on those dates. So huge, huge dividends that they're going to be shelling out. And then we can reevaluate what the valuations look on those plays at that time. But as of now, we're going to be holding here for the next about month and a half. and then readdress if we want to continue to hold them for the long term. A change that we are seriously going to be making here is looking at LGOV. If you remember, we've been talking about extending the duration of our bond portfolio. Remember, when interest rates go up, bond prices go down and vice versa. So now that we have been, and this has been the narrative of why we bought this position, as interest rates go up and up and up and up, and we know that we're at closer to the end of the rate hike cycle than we are at the beginning, as interest rates start to stop and potentially go down, what does that do to bond prices? Bond prices go up. Longer duration bond prices go up more than short duration bond prices. So LGOV was a position to extend the duration of our bond portfolio to take advantage of what we know is coming, a stop and at some point a cut in rate hikes. Now, again, same thing. We got in a little bit early, but we didn't want to be late to this play. We really think that long duration bonds have the potential to give some stock-like returns over the next year or so. However, we don't know when the Fed's going to cut rates. We don't know. They're not going to tell us. We have no idea when that's going to happen. LGOV has been a pretty volatile position, which we're going to keep. We're going to keep our position in it. However, we're going to trim a small portion of it, probably about a quarter of the position, and we're going to move into this position that's UConn, UCON. It is also a bond fund, so we're just moving our bond portfolio a little bit. What this UConn fund does is it allows the fund managers to determine the duration of the bond portfolio. So without getting too far into the weeds, basically LGOV, most of the bonds are 10-ish years to maturity, which is pretty far down the yield curve. UConn has the ability to move that lever back and forth depending on what they see. So they can sit in short-term bonds, they can move out to long-term bonds. Right now they're pretty average. I believe they're more around a 5 or 6 year yield to maturity currently. So it's a little bit more defensive. We didn't want to get rid of our LGOV exposure. Again, we're still very bullish on it. However, in order to limit some of the volatility that we've been seeing, we're adding a little bit of exposure to this UConn position. So you're going to be seeing that within your accounts. Again, nothing major. It's not a huge change. We're still bullish on long duration bonds. Again, we just don't know exactly when the Fed's going to stop or start cutting rates, and when that will be, that LGOV will be able to take off. So again, today with the news, it's been rallying huge. I mean, it's not often that you see bond funds going up almost 2% in a single day, but that's what it has the potential to do. So not getting rid of it, just limiting some of that exposure. So again, nothing too crazy, but you will be seeing that within your portfolios. And we're going to keep an eye on the bank stocks. Still, from a valuation perspective, they're a great spot to be. And we're going to readdress whether we want to hold them going into the new year after we get the dividends from them, which are going to pay substantially. So that's kind of everything right now. Again, I'm sure you're tired of hearing about the Fed, but unfortunately, that's one of the main topics of conversation and something that we got to keep a close eye on. So if you guys have any personal questions at all about your situation with your exact portfolio, as always, feel free to reach out. If not, I'm going to be bugging you about, if we haven't already met, I've met with most everybody already, but hopefully by the beginning of the new year, we'll get everybody else getting on those semi-annual reviews and get those taken care of. So give me a call if you have any questions at all. I'm more than happy to chat. And I hope that everyone has a great Thanksgiving, and we will talk to you at the end of next month on our next monthly market update. All right, guys, have a great one. Talk to you soon. Bye.